Hello everyone and welcome back. Today I'm excited to give you a walkthrough on how to actually use Uniswap V3's concentrated liquidity. So providing concentrated liquidity for the average user is actually something that's pretty accessible and it's really profitable. So as you'll see in just a bit, returns on some of your favorite pairs like ETH and USDC and ETH and WBTC are actually really lucrative. So I'm going to show you everything you need to know to enter those pools, and then I'm also going to show you how to calculate what your return will actually be. I'm also going to weigh the pros and cons of how concentrated you actually want to make your liquidity position, and I'll show you a tool to kind of estimate that for yourself. So if you find a unique pair that's not covered in this video, which is probably going to be the case, you'll have the tools needed to actually tackle that and put the right liquidity position in Uniswap. Before we get started, please like the video, it definitely helps me, and if you're not already subscribed, please do so and hit the notification bell. We also have a community Discord channel that's below, and if you have any questions here, that channel is actually a great resource. There's going to be a ton of people that are ready to help you and want to talk to you and just excited about DeFi in general. So let's jump right into it. Just want to go over at a high level. Basically, Uniswap V3 allows users to deposit concentrated liquidity positions. What that means is if you're, say, providing liquidity for USDC and ETH, let's just say, you're no longer providing liquidity for the whole price range. You're going to set a range that the two assets are going to be trading at, and that's where you're going to be providing liquidity. So ETH right now is about $2,500. So you might say, as long as ETH is trading between 2,200 and 2,800 USDC, I'm willing to provide liquidity for that range. Now this has some pros and cons. Basically, the more concentrated your position, the higher amount of swap fees you're going to earn. The downside here is if your liquidity position is extremely tight, that means the price of ETH or the other asset could get out of that range, and therefore your liquidity is just sitting there and not actually providing liquidity to Uniswap users. The other caveat here is that the more concentrated your liquidity position, the greater your impermanent loss is. Now, the other thing about a concentrated liquidity position is that the more concentrated the position is, the more impermanent loss you're going to face. Some folks do really worry about impermanent loss. I'm personally not one of them. I don't really factor it in. I'll include an article I wrote below that just talks about why I generally don't worry about impermanent loss. So now that we've gone through those caveats, let me just show you what the Uniswap V3 pool looks like. Now I'm going to break down everything you need to know about this add liquidity page, but I'm also going to show you some tools later on in this video that will make this a bit easier, so definitely stay tuned. Now for the first pair I'm going to walk you through, I'm using ETH USDC. Now the reason for this is because when you're pairing something with a US dollar denominated asset like USDC or DAI, it's a bit easier to understand how the liquidity works. The reason for this is we're pricing an asset to the US dollar, which is kind of normally how we think about assets. This gets a bit confusing when we talk about, say, a Bitcoin and ETH pair, but I'm going to walk you through that in a minute as well, so don't worry. Just going down, you can see we have three options for fees. Now, the first option is a 0.05% fee. Now, this is used for stablecoins. The reason being is you can get a really tight range of liquidity for stablecoins like USDC and DAI pair. With this pair, the prices of the two assets are basically always going to have the same ratio of about 1-to-1. So you can get a really tight range and capture a ton of volume there. There's also no risk of impermanent loss because the assets are pegged to each other. So in this case, with a stablecoin, you would choose a 0.05% fee. Now the middle option here is 0.3% fee, and this is what we had in Uniswap V2, and this is going to be the most common fee level for the average pair. You can see there's also a 1% fee, and it says best for exotic pairs. I personally haven't seen any large liquidity pools that charge 1%. Frankly, I just think this wouldn't really be efficient probably for most pools, and that's just too high of a fee for users to pay, so don't worry too much about that one. Now, next up is the price range. You can see right now the price range is a minimum of about $2,000 per ETH and a maximum of about $3,000 per ETH. You'll also notice that below that you can see there's a minus 0.6% and a plus 0.6% toggle switch. The reason why if I were to type in, say, $2,000, it's going to automatically switch that to just under that is because Uniswap actually has a tick mechanism. It gets a bit complex to explain, and you probably don't need to read the full details here, but you're welcome to, and I will include a link to the docs below. But basically, Uniswap positions liquidity on discrete tick marks, and they'll automatically select those ticks for you, and you can toggle through them with these buttons here. But again, you don't have to worry about being that precise. What's handy here is you'll see the current price of ETH right now is about $2,500. So I just have a wide range here selected of 2,000 to 3,000, which is, again, probably something I'm going to recommend for most of you, but I'll get into that a bit later. After that, it's really quite simple, and you can just deposit your amounts and you have that liquidity position now. Now, you will have a pretty helpful dashboard when you actually create the position. One thing to note that's pretty important is because the Uniswap V3 positions are NFTs, you're not actually going to auto-compound your rewards in these pools. What that means is you have to withdraw the rewards and manually compound themselves or do whatever you'd like with them. Now, before I show you some of the tools that are going to make this easier, I do just want to touch on a non-traditional pair, non-USD denominated pair like WBTC and ETH. The only thing to note here is it just gets a bit confusing looking at the price because we don't have that US dollar reference that we're so used to. So for a pool like this, where one of the assets isn't a US dollar denominated assets, you're basically going to think of things as a price ratio. So you can see right here that it costs 15.6 ETH to purchase one WBTC, and you can set that ratio in the min and max sections here as well. Again, that's a bit confusing, but just think of it intuitively. So if it costs less ETH to buy one WBTC, that means the price of ETH outperformed WBTC. When you're not using a USD denominated asset, you want to look at it and think about which assets are going to underperform or overperform the other asset in the pair. So now that we've gone over the basics, I do want to briefly show you this Uniswap V3 fee calculator that I found that's been incredibly helpful. I'm going to link this below. So basically with this calculator, all you have to do is select the pool you're interested in. I've selected that here. And then you put in the investment amount you're interested in depositing. For this example, I'm just using a round number of $10,000. Now, right off the bat here, you can see on the right how much you're going to be earning in 24 hours of providing this concentrated position, and that's $21 in 24 hours. And you can see the annual APR, and again, this is not an APY because it's not auto-compounding, is 79%. That means if you were to compound this yourself, the return would be much higher, which is great for an ETH USDC pair. There are a couple things to note here. So on the left here, you can see you want to make sure that the price is accurately depicted here. In this case, ETH is about $2,500, so that makes sense there. And then you want to select the concentrated position or the liquidity bound that you're willing to deposit into. I'll play around with this briefly. You can see the more concentrated around the price I make that bound, the higher your actual return is going to be. So it's a bit of a risk-reward trade-off. If you have a more concentrated bound, you're probably going to have to manually change the concentrated price more frequently just because ETH is a volatile asset, or all of these other cryptocurrencies are volatile as well. But the tighter you're able to make it and still provide liquidity for that range, the more your return is going to be. For a lot of people, they're probably comfortable providing liquidity for, say, a $2,000 to $3,000 price range. And you can see the return for that is still pretty phenomenal at 41% APR. For a volatile asset like ETH, I think an $1,000 range is pretty sufficient. So you have $500 of price protection below and $500 above. You can see here it'll also show you the min and max prices of the last 5 days, which is handy just to see how the market's trending. They also have the last 5 days of swap volume, and that's how they're calculating this annual APR. So of course it can't be that precise because sometimes people are swapping a ton of assets and sometimes they aren't. But this is a good rough estimate and something you could keep checking back on. So this is a phenomenal tool, and I want to show you how you can use this for non-USD denominated assets or assets that are just generally correlated. So you can see here we're back on the WBTC ETH example, and I think this is a great example because these are two appealing assets to investors, of course, but these assets are also very correlated, which means you can actually have a tighter range than you'd think. To that end, I want to show you this brief correlations page, and I will link this below. But you can see that BTC and ETH here, if you look on the chart, they have a correlation of 0.83. Now, a correlation of 0.83 is actually really, really high. So if BTC and ETH had a correlation of 1, that would mean that you could have really the most concentrated price tick possible and still capture all of that liquidity because the prices move in tandem. But a correlation of 0.83 is actually really high in itself, which means we can actually make a more concentrated position than you'd think. So again, I'll link this resource below. You can compare other assets too if you want to do your own research. But let's go back to the calculator here. So as I mentioned, you can see they have the current price here, which means it costs about 15.6 ETH to purchase one BTC. And you can see here you can select the bounds. For reference, we can see that the high of the last 5 days was 13 ETH for one BTC, and the low for ETH was 16 ETH for 1 BTC. So you can see here for a liquidity bound of 12 ETH to 1 BTC and 17 ETH to 1 BTC is giving you about a 40% APR, which is absolutely phenomenal for getting return on ETH and BTC because you're getting your return in those assets. This is obviously phenomenal and something you really can't find elsewhere. And the return is also pretty good if you have a really conservative and wide bound. So if we make it 10 ETH to 1 BTC and 19 ETH to 1 BTC, we can see you're still getting about a 24% APR. If you were to compound that, it would be significantly higher. But that alone, even if you don't compound it, is really phenomenal. You really can't find those yields elsewhere. Now, I did want to jump in and show you what a stablecoin pool actually looks like. So this one is actually quite easy to set up because you can have such a close price range. So in this example, you can see I have a pretty tight liquidity bound, and you can see for the USDC USDT pair, it's still yielding about 13.5% per year in an APR. Now again, of course, the more concentrated you're able to make this position, the higher the return will be. You can see if I tighten the bound even tighter, and now that's thousandths of a cent, you can see the APR will jump to as high as 24%, and you can go even more concentrated than that. Now this all depends how comfortable you're able to concentrate this position. There is still going to be some price fluctuations with stablecoins, but as the market develops, we would expect these two assets to trade at even tighter of a peg. So just something to consider and keep in mind. So I think in the future it is possible these yields could come down as more people start to deposit into Uniswap V3 and get better at concentrating liquidity. But for right now, I would really recommend you play around with this fee calculator, look at what assets are correlated, look where you want to provide liquidity. Check out which assets you're comfortable with. I think most people seeing this probably want to hold ETH and BTC, so this pool itself might be a great option for you. But that's all I have for you. There's just so much to Uniswap V3 that it's hard to put it all in one video. But if you have more questions, again, the Discord is linked below. Please join us there. With that said, please like the video and subscribe if you haven't. Thank you all so much for watching, and I look forward to seeing you all in the next video.